funsupermart.com.
Hello everyone. Recently, we've seen a general decline in commodity prices. Joining us today is James Govan, investment manager of Baring Global Resources Fund, who shared with us his views. Hi James, thanks for joining us. Has the investment case for resources changed much in the third quarter? And what is your general outlook on the sector in the next year?
Yes, so if we look just beyond the quarter, over the last few years, we would say the resources investment case has changed. And previously what people focused on was the macro drivers, Chinese growth, the commodity super cycle. But actually, what we've seen recently is a sort of a change in the strategy of a lot of resource companies. So many companies realize that actually, the commodity prices have been struggling for a couple of years, and we can't just rely on, the commodity prices going up and up and up to support earnings growth. So, there are still some structural stories in resources. So one example we like to use is North American timber. Anybody that's driven across the US will realize how many houses are constructed out of timber. And so, we think that the US housing recovery is at an early stage of recovery, and that over the years, the housing market will go up, and that will tighten the timber market. But, beyond that, if we look at the links within the commodity chain as well, what we're seeing is some deflation in natural gas in America, providing opportunities for other industries, the chemicals industries, where these companies use natural gas as an input. And so it's generating very strong revenues and cash flows for these businesses. But on top of that, as I said at the outset, these companies, the resource companies, the ones that we seek to identify, are looking at other avenues to grow rather than just relying on the commodity. So, what they're looking at, self-help, that we've got consolidation in the sector. And as we look at the sector overall, we think that actually, particularly given the sharp fall-off in many commodity shares, that actually it is an interesting time, certainly for contrarian investors, to have a look at the space. So, for example, in our portfolio, we believe stock selection is absolutely paramount. In our portfolio, the PE of the portfolio on the next 12 months basis is only 13 times, for consensus earnings growth over the next 12 months of 20%. So we think actually it is a very interesting time to start looking at the sector, despite the underperformance against the broader market this year.
The strong US dollars in the third quarter resulted in a general decline in commodity prices. What is your advice to investors investing in commodities?
Yes. So that is an excellent point. Obviously, the dollar strength has been a headwind for all commodities. So, for all non-US people, obviously paying dollar-linked commodities, it's a headwind. It's more expensive for foreigners to buy commodities. But in addition to that, it wasn't just the dollar strength. We also had supply coming on in certain commodities. So obviously the one that everyone's looking at the moment is Brent crude, which has been very weak. And what we've seen there is actually supply increases. So we've seen 1 million barrels a day coming on in the spring from both actually from Libya and Nigeria combined, which has surprised people. We've also seen continued strength in terms of supply coming out of North America, and actually demand weakness. The other, I guess, big commodity that people have looked at that has been weak is iron ore. And what we've seen there is continuing supply increases. But, the situation we're in now is actually in many commodities, we are into the cost curve. And so actually, we think that for many commodities, a lot of the damage has been done. So as we look forward, certainly, with crude oil, it has been weak, but we do expect actually a modest rebound. We see the long-term fair oil price between $80 and $90, but we think, seasonally the winter's strong, and actually we see increasing demand from refineries for crude oil. And within certain base metals, for example, zinc, we particularly highlight which is in a deficit market, and that deficit will get bigger as we go into next year, particularly with the large Century mine coming offline. So we'd be positive on many of the base metals. Iron ore, we're still cautious, however, because we continue to see strong supply coming on from the low-cost producers in Australia and Brazil over the next few years. But overall, we think actually most of the damage in a lot of the commodities is done, and we're more constructive here.
Is there any major M&A case in the resources sector lately? And is there any implication to investors?
Yes, so an excellent question. So we are seeing some more in M&A, and something that you would expect given the performance of the resources equities hasn't been great over the last few years. So the corporates have, confidence in the outlook, and in fact willing to leverage up the balance sheet, so to take on more debt in order to do these deals. So what we've seen in agriculture, we've seen talks between Monsanto and Syngenta, the big seed and crop chemicals companies. We've seen actually a animal feed company in Holland, Nutrico, being bought by private equity. In mining, there's been the chatter between Rio Tinto and Glencore speculation. And in energy, we have seen actually some deals done in North America. So it is a continuing theme, and the implication for investors is the companies are seeing value in the sector, and they're willing to gear up their balance sheet. So it shows that they have confidence in the outlook. So that's maybe something that investors could sort of take some heart from the corporate actions.
Could you share with us your equity investment strategy in the resources sector?
Yes, yeah. So really within the resources, our focus is really on the companies, not the commodities. So what we seek to identify is companies that can perform in a benign commodity environment. So if we do get the Chinese economy really growing very, very fast and the return of the super commodity cycle, that would be a turbo boost for the portfolio rather than having to rely on it. So a great example of the sort of company that doesn't need necessarily a very bullish or very positive environment in order to grow earnings would be Monsanto, which is a US seeds company, and they have doubled earnings in the last 5 years, and the management is targeting to double earnings in the next 5 years. And this growth is not dependent actually on a particularly positive soft commodity environment. They need only to see a reasonable soft commodity price environment. And with the strength in terms of the portfolio that they have and the pipeline of products that they be releasing, it's the sort of company that we like to focus on, and that gives us confidence actually going forward in our portfolio that we should see some good earnings growth going forward.